The Fed finally announced its 0.25% rate cut last week, and this actually made mortgage rates go up by 0.24%. Why is that? I'll explain in a minute. We saw another big jump in the number of people applying for mortgages this week, and it's clear that sellers are noticing and trying to take advantage of this increase in demand because new listings are finally growing again. Well, at least they are nationally. Both Dallas and Collin County actually saw a decrease in new listings this week, but nationally they're growing. After a very concerning jobless claims report last week, the jobless claims numbers came right back down to earth, reminding us why we never lean on 1 week data. We only look for trends. This week's video is going to be shorter than normal because I have literally no time this week. But my name is Michael. I'm a real estate agent here in the Dallas-Fort Worth area, and every Monday, hopefully, I give you a weekly market update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button, and if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is September 23rd. Let's see what the data is telling us. If this is an old video, you can click the playlist here to get to the latest weekly market update. Okay, starting with market news. It was a wild ride for mortgage rates last week, but ultimately we ended up with higher mortgage rates than we started with, even though the Fed announced a rate cut. But if you've been following along with my videos, you'd already know that this is a totally normal outcome. By the time the Fed actually announces a rate cut, the move has already happened weeks ahead of time. And what happened here is mortgage rates got all the way down to 6.13% before the announcement, and after the announcement it went up to 6.37. And there's a couple reasons for that. So the main reason is that the bond market had already priced in the Fed cut, and it got a little too excited right at the end. And then once the Fed actually made the announcement, I think the remarks that the Fed made were not as dovish as they were hoping, and that's one reason it bounced back up. But also the reason that rates were able to get this low in the first place is something that nobody ever talks about. It's called the spreads. And one day I'm finally going to make a separate video just on this so I can just reference it, but for now I'm going to try to explain it as quickly as possible. But this is how mortgage rates are actually determined. So one, you have the federal funds rate. That's the Fed. That's the main thing everybody is always worried about, and that's the baseline that everybody works off of. Then two, on top of that, based on the federal funds rate, you have the bond market, which is constantly fluctuating, and it's trying to forecast what's going to happen next with the Fed. That's why the bond market moves weeks ahead. But then on top of the bond market, you have the banks, which are adding their investor margins and their own costs on top of both of these things. And this explains why we just had the first federal funds rate cut in an entire year. And yet throughout that year, rates got as high as 7.24% and as low as 6.13% without the Fed cutting or raising rates one single time. So hopefully you can see the federal funds rate is not the main thing here. So I need you to understand this. Mortgage rates moved a full swing of 1.11%, which is a huge move without the Fed doing anything. So I just need you to know the federal funds rate is not the main thing to be watching. So you have the Fed, then the bond market, then the banks on top of that. That's how mortgage rates are determined. And the banks are the ones who actually control the spreads, which is the thing I'm trying to teach you about today. All you need to know is that when there's uncertainty in the market, the spreads get worse. And when I say the spreads, I literally just mean the literal spread between the 10-year treasury rate and mortgage rates. That spread between those two numbers is banks determining how much of a safety net do we need to protect our investors. So when the market is feeling very certain, they need less of a spread and they can charge lower mortgage rates because they feel safer. When things feel uncertain, they charge a bigger spread if they're worried about what's going to happen with mortgage rates to create a cushion to protect their investors. So this is what the spreads have looked like for the last 3 years. And if you'll remember in 2023, when everyone thought the Silicon Valley bank collapse was going to be the end of all banks, spreads got way up here above 3%. This is why mortgage rates got so high. Banks were in a full-blown panic and they needed to add a large cushion to protect their investors. Obviously, things turned out just fine, so you can see after 2023, spreads improved last year and they're improving even more this year. And as of today, you can see we're the lowest we've been in all 3 years, and we're all the way down to 2.19% of spread, but historically, we actually should be more like 1.6 to 1.8, so we should be right below the 2 here. So this spreads number, this is the main thing allowing us to get all the way down to 6.13. And just so you know, if the spreads were as bad today as they were here at the peak of 2023, mortgage rates would be a full 0.91% higher than they are now. So The real hero of low mortgage rates is the spreads improving, meaning banks are feeling more certain about the future of financial markets and seeing mortgages as less risky, so they're charging less of a premium. And this should matter to all of those of you who think that a housing crash is imminent, because banks are showing you they actually see that things are stabilizing and improving, not crashing. And again, the reason that I think mortgage rates went from 6.12, I think that was an overcorrection to the downside. And then once they heard the Fed's actual remarks, they heard that this is not as dovish as they were hoping. I think it's clear that it's going to be harder to get future rate cuts than they thought. And that's why rates went back up to, I think it was 6.37 right after. So they were hoping for a more dovish Fed. They got down to 6.12. They heard they're not as dovish as we thought, so 6.37, which I think is probably an appropriate response. But also, nobody knows anything. It's really going to depend what happens in these next few labor reports. If we get a few more bad labor reports in a row, rates are definitely coming down and the Fed is definitely cutting more. But yes, all that happened here, the bond market was feeling very optimistic. After they heard the remarks, they were feeling less optimistic. So rates went up a little bit. Oh yeah, and I wanted to show you this zoomed out mortgage spreads. This one goes back to 2015, but you can see normal spreads really are below 2%. We have been way up here. So like that's what we're used to. But like I said, we're at about 2.2 now. If we were to get even down to a 1.8, that's a 0.4% better mortgage rate than we have today. So instead of 6.35, we would be at a 5.95. And again, that's without the Fed doing anything. That's just spreads getting back to normal. So in theory, we can get below 6% rates right where the Fed is right now, just so you know. Lastly, I wanted to show you the jobless claims, because last week I showed you this huge spike and I told you that's 1 week data. We don't rely on it. You can see it always comes right back down every time that happens, and usually it comes back down even lower than it started. And once again today, it shot up from here and it's back to lower than that. So I covered this last week, but even this spike is not actually concerning, because 260,000 jobless claims is actually very low. It's just that if a job loss recession is coming, we're going to see it in the jobless claims numbers, but there's nothing to be concerned about until the 4-week average gets above probably like 320,000. And again, that's the 4-week average. This is just weekly got to 260. So we're nowhere near the danger zone, and even less so because we came right back down. Okay, there's no property showcase this week because I have no time. Moving on to the national housing market, we're starting with national single family inventory. This week we had an increase, a very small one, of 2,664 more homes for sale in the country. You can see it looks pretty flat. The peak so far was still in August, and even though we had an increase, this actually drops us 1% to just 20% more inventory than we had last year. Remember, earlier in the year we got as high as 33% more inventory than last year. It's very unusual that we would have peaked in August, and it does look like we are going to so far. As you can see, the previous 3 years we have peaked in October, November. I think it's very unlikely this number goes higher. It's possible, but even if it does, even if it goes slightly higher than this August peak, it's still clearly a shift from the previous years. And I think all it's showing is there are more buyers coming into the market than there are listings, which is what the rest of the data is showing us. As rates drop, more buyers are going to come in earlier in the year and cause inventory to decline earlier. That's what we're seeing. So unless mortgage rates go back up, it's likely we've seen the peak or we're very close to it already. But we increased up to 862,883 homes available for sale in the country. This same week last year, we only had 725,249, so still much better than last year. And then for reference, the all-time inventory bottom in 2022, we only had 240,000 homes for sale. The peak of last year, we had 739,000 homes for sale. Now looking at new listings this week, this is actually really good news. We had 1,785 more new listings than last week, which is actually 3,205 more than last year, for a total of 66,228 new listings this week. And this is great because we know that buyer demand is coming in with these low rates. So as demand increases, we need more new listings. So this is good news. If this number were to continue down, which again, this is 1 week data, it could come back down. But if this can continue to grow while demand grows, it's going to keep things feeling more normal. It's going to keep prices from going up. It's going to keep you from multiple offer situations. It's going to keep inventory at manageable levels. So we need more people listing their homes as rates drop. And at least this week, that's what we got. And for whatever reason, there was no overall pending sales chart this week, so we're just going straight to the weekly pending sales, which you can just think of as new single-family contracts. This week, new contracts had a big jump of 2,206 more homes going under contract for a total of 62,185 contracts this week, which is also 2,493 more than we had the same week last year. Actually, something is wrong with this chart. That was last week's numbers of 62. This week, this jump is actually 64,391. So don't pay attention to this number. There are 64,391 new contracts this week. And then the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a cut before selling. Looking at the national chart, for the third week in a row, we are completely flat at 41.5% of homes taking a price cut. And as you can see, we're following very similar to this line, which is last year's trajectory. So I would expect we've already seen the peak for the year, and we're gonna flatten out around here, and we're gonna slowly trend down through the rest of the year. So that definitely seems like the most likely outcome, especially with this rate drop. But last year we got as high as 39.9%, the year before 39.2. Back in 2022, we got as high as 43.2. It doesn't look like we're gonna get that high this year, but just know if you want prices to continue down, then this number would need to be continuing up. It's not. I think that prices have probably stopped their descent for the year. Now looking at mortgage rates, as we discussed last week, they got as low as 6.13, and then right after that, they got as high as 6.37, and now this week they're down to 6.35. Again, I think it's just the Fed's remarks were not dovish enough for them. So the bond market pulled back a little bit, felt like they had overcorrected. But these are still great mortgage rates, well below the rest of the year, as you can see on this chart. Still well below. Then regarding mortgage purchase applications, this week we had another 2.9% increase week to week, which puts us at 25.5% year over year gain in the number of people applying for mortgages, which gives us 30 straight weeks of positive year over year growth. But I've been saying it for more than a year now. This number is really going to grow once we get and stay below 6% for a sustained period of time. We got pretty close for one day there, but we're still closer to 6.3, 6.4 for now. So this is a lot more demand than last year, but this is nowhere near normal still. We're still very suppressed with these high rates. But as you can see, for many months now, more and more buyers are stepping into the market. Okay. Super quickly, moving on to the local markets, starting with the MLS data of Dallas County. We had 569 new listings, which is 38 less than last week. So that's a departure from nationally where new listings increased. And you can see outside of the last holiday week, which was a super low number, 569 is lower than we've been seeing. And you can see 569 is not super concerning. We had 557, 599, 579, 549. This was an anomaly week, so you should really just average these two out, 651 and 488, because holidays get weird. But we had a 607 after that. So 569 is not super concerning. It's in the ballpark of where we've been the last few months, but it's obviously not ideal if buyer demand is coming into the market. We don't want to see this number going any lower. Number of closings, we had 251. That's 22 more than the previous week. Of those homes closed, 39 were immediate sales, meaning they contracted within the first week. That's 13 more than last week. We had 298 new contracts this week. That's 6 less than last week, but it's more than we've been seeing, 279, 268. We had a big jump last week at 304, and 298 is only 6 different than that. So it does look like more new contracts are coming in the last few weeks. And in total, we have 2,182 homes either under contract or pending. That's 34 more than last week. Moving on to the same thing, but looking at Collin County, we had 390 new listings, which is 80 less than last week. So looking back, 390, we had a 340. I believe that was the holiday. So 422, 470, 479, 406. So yeah, 390 is actually quite a bit lower than normal in Collin County, so we don't want to see that trend continue, especially when it looks like contracts are going up. But let me not skip. We had 248 closings, which is 50 more than last week. 23 were immediate sales, which is 9 less than last week. New contracts, we had 201, which look at the previous weeks, 178, 157, 190, 206, 173, 192, 202. So 201 is right at the top end of what we've been seeing as far as contracts, and this is not the time of the year when you would typically be seeing that many contracts. So what you can see here, we have more new contracts than we should, and we have less new listings than we should. These two things, if this continues, this is showing you that prices are not going to continue dropping. They've probably stopped. And if this continues long enough, then prices would start to go up. But this is just the beginning. It's just 1 or 2 week data. We're looking for trends to develop, and if rates continue low, this could be the start of a trend. And in total, 1,981 homes are under contract or pending. That's 11 more than last week. And we're skipping the market action index this week because I have literally no time. I don't even know how I'm gonna edit this and get it up today. But very quickly, let's do the hottest and coolest cities and zip codes. These are ranked using the market action index, which you know about if you've seen my videos. Otherwise, you'll see what it is next week. But any number at 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in? And this week, Carrollton and DeSoto and Coppell all remained in their top 3 spots. Lancaster heats up 1, Grand Prairie cools off 1, Grapevine remains, Irving heats up 2, Sachse remains, Hutchins jumps onto the list at number 9, and Richardson remains number 10. And then Duncanville, which was number 7, fell off the list this week. Then zooming into specific zip codes, the absolute hottest is Irving, Texas, 75061 at a 46.82, so much hotter than Carrollton at the city level, followed by Carrollton 75007, Grand Prairie 75052, Dallas 75206, Lancaster 75146, Garland 75041, Carrollton 75006, DeSoto 75115, Dallas 75249, and Irving 75062. So if you have a home in one of these zip codes, you should be able to sell for top dollar. Now same thing, but the coolest cities and zip codes. Leonard cools off 5 spots this week. Remember, everything at 30 or below is a buyer's market, so everything below Sunnyvale, these are all buyer's markets at a city level. So Leonard cools off 5, which means Anna, Royce City, and Prosper all heated up 1. Then Whitewright heats up 4, Rockwall heats up 1, Salina cools off 1, Nevada heats up 1, Van Alstyne remains at number 9, Sunnyvale jumps onto the list at number 10, replacing Lavon, which was number 10 last week. Then looking at the zip codes, all of these are buyer's markets at a zip code level. The absolute coolest is 75452, that's Leonard, followed by Anna 75409, Dallas 75233, Rockwall 75087, Royce City 75189, Prosper 75078, Whitewright 75491, Dallas 75204, Salina 75009, Nevada 75173. That's it for this week's super quick video. As always, if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. Call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.